Okay, the screen that you're looking at the moment is the FTSE 350, so the top 350 UK companies. And what I want to show you here is how some shares just become out of favour when they can start out really popular. So what I've got here is the performance of the top 350 over the last 5 years, so indicated by this column. So the worst performer here is a company called Lonmin, who you may have heard of, and Lonmin have been, just open this up, have been a company involved in extracting, refining, marketing of platinum and platinum group metals. Okay, so very popular at one time, and I'm just going to show you by looking at this graph what they were like. So this goes back to January 94, so quite some time ago, so we're talking 20 years ago now. And I'm just going to show you what happened in the early stages with this company. So make that even closer for you. So you can see here the share price was in November 2005, it's about £7 and 43, and there was a lot of strength in the market for buying this particular share, and you can see a nice uptrend here all the way through until about July 2007. So the price went up to £22 per share. So if you got in down here, which was around about the £6-7 mark, you'd have been very, very pleased with that. You'd have pretty much trebled your money over that period of time. So from in 2 years really. So that would have been fantastic. Now, this myth about investing in companies over a long period of time, 5-10 years, what I'm going to do is just explode that myth for you, that it's all about trending sectors, and in this case the mining sector was just trending beautifully. So Lonmin was just one of a number of different companies in the sector that had done fantastically well. But let's just see now what happened after that. So keep in mind that the share price was £6. It hit these dizzy heights here of about £22, and then it started to drift downwards, and then there's a sideways move, and you can see just here there was a big spike. But this was August 2008. No surprise there, as we know what happened at that point, which was when we had the stock market crash. So Lonmin then went all the way down in December 2008 to £3 a share. And of course, if you'd been in at £6 in 2005 and that had gone up to 22, £23 and is now fallen to £3, you'd have been pretty unhappy that you'd held on to those shares. But this is what happens. This is what most people do. They buy a share at a low price and it goes up and up and up, and then they just watch it continue to fall with no exit strategy, no strategy to take the money. And had you done that when it hit the £23 per point, you'd have been very happy. But conversely, very annoyed having watched it go to that dizzy height of £23, only to fall to £3. But as with other shares which have done very well since 2008, which I've talked about before, Lonmin just haven't really done anything. You'll see, naturally you would see that it would go up from £3. I mean, anything since 2008 has pretty much gone up, however bad a company it is, as long as they're still trading. But with Lonmin, their progress has just pretty much been sideways, and I'm just moving cursor along now so we can see 2011, so this is around 2011. So the share price has just been moving sideways and now starting to fall at this crossover point here which is in May 2011, so about £8.30, and it's just continued to drift south. So if you'd shorted the price from here, you would be very, very pleased. You can see that just touching the blue line there. It just shows the resistance point. Eventually it breaks the resistance point, which is the time that you will bank the money. But here's another opportunity to have shorted Lonmin, just around there, about £5 at Christmas of 2012. Again there, so let's just make that nice and clear for you. So that would have been a great time to short Lonmin there, just at March 2012, at around what was the price there? It's $5.92. Again, you could have had a chance to shorten at that point, and look at what happened next. Just fallen, and that would have been a great time to have taken the money just about here. It's fallen further, so you could have even just stayed in and it gone down a little bit more. So the price now, I mean, this is November 2012, £2.50. £2.50. So not a great result if you'd been if you bought Lonmin shares and you just decided to wait for the long term, say they go back up, you know, and wait for 10 years. It's not happening. You've got to find the point where you're going to exit, and you can always get back in on these particular shares if you felt that there was a good reason to get back in. So let's see where they are now. So we go forward to 2014. You see again, it's fallen, hit the blue line, again hit the blue line, so more and more resistance, and the price being pushed back down. So as at today, we're back at the £2.20 mark. So it's all that excitement of it maybe recovering and going back up to £3, £4, £5, and it's now fallen all the way back down to £2.19, £2.20. And if you'd shorted it, you'd have done very nicely out of shorting Lonmin, especially if you shorted them from £22. And you know, is there going to be a time to get in? Well, I certainly wouldn't want to buy Lonmin at the moment, because there's just no signs that it's going to be going back up. But maybe in this particular sector there will be a turning point, and if there is, and signs are looking good for Lonmin, then I'd be back in. But at the moment, I'm leaving well alone. But the point of this particular video really is just to see how you can be lured into just buying into a particular company and staying in there, and forgetting that all sectors change. You know, they're trending all the time. Some are are really in favour and doing amazingly well, and then some are out of favour. And in this case, the mining sector has been out of favour. So if we looked at the mining sector overall in the last 5 years, it's been absolute pants. Whereas if you look at the health sector or technology sector, it's been totally the opposite. So that's the importance of knowing what's happening in certain sectors that are trending very well, and buying shares in those particular sectors that are trending well, trending upwards. So, you know, going long on those particular sectors, such as technology and health, and then short in the mining sector. So you know, you're winning both ways. So I hope you enjoyed the video. But the two things just to take away from this are: one, don't stay in the share just because you've fallen in love with it, because it will hurt you in the end. Find when you're going to get out, when that exit point is, and bank the money, and then you can get into something else that's trending nicely. And the second thing is just take care of your money, and don't buy in to stay in the long term. Okay, hope you enjoyed that, and look forward to speaking to you next time.